Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Wednesday, April 19th, 2023, and this is Blockhead Traders Weekly. In this week's episode, I'm joined by fellow Blockhead trader Viper XL 007, and we have an interesting episode this week. We're going to put it in the education column, and we are going to talk about delta. And knowing your delta means knowing your risk. And you could look at that and say, what the heck is delta? But we're going to explain that to you this week. Then we're going to show you some tangible examples in some futures trades of the Russell, which is the RTY, as well as the micro ES futures. And we'll talk through some of those and show you in the portfolio what the impact is and how that relates to delta. But before we hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, several other Blockhead traders. Love to hear it. You're trading. Love to hear what type of content you want to listen to. Additionally, you can go to thetagang.com/sprocket888, where I have each and every one of my trades, the good, the bad, and the ugly. This show is also available wherever you get your podcasts, so look it up and subscribe. If you can't find it, let us know and we will get it there. But let's hop to this week's content. Viper, I want to talk about risk. And you know, I think we've chatted on this topic of risk off and on periodically. And I think I've made several references to the difference between a good trader, a great trader, and I guess a spectacular trader isn't really how they pick their winners. That you have to be able to pick winners. You can't just always pick losers. But the biggest differentiation between different levels and performance of trading, I feel, really come in the aspect of risk mitigation and keeping your losses small. When you look at traders, then if you go with percentage of wins and percentage of losses, I would speculate that there's not that big of a difference between the percentage of wins and percentage of losses for particular trading styles. I think the law of statistics kind of works a lot of that out. I think the real difference is how big are those losers? How long do you hang on to them? How do you control that downside risk?
Yeah, I feel like along those lines, and I think anybody watching this that's fairly new into the market, and I would guess a fair number of people, I wouldn't say everybody, but a fair number of people have gone through the growing pain of your biggest losses come from inconsistency. Your biggest losses come from, maybe you made a couple good trades and then the next one after that you get super excited about or emotionally attached to, and you go bigger. You're like, oh, I've been winning, so that means I need to amp up, and you change the pattern and you change what you're doing. And then that's where the biggest losses come from, because you've lost track of the puck, and you've lost track of the management of your risk. And so I think it's very important to, and it depends on what you're doing here. Like, are you here for the Wall Street bets, gambling stock moonshot, or are you trying to build wealth steady and sustainably over a longer period of time? And obviously we're on the latter side of that, and consistency is just, I don't want to say it's secret sauce, it's the sauce. And so a big part of that is knowing how to manage your risk. It's not just stop losses or something like that. So I think it'll be a good educational topic to dig into here.
Yeah, definitely. The where I'd start out is I am, a very technical, I guess, person by my very nature. And so I like very objective things. I like things you can measure, things you can understand, things that are not subjective. We make references on this show that you cannot trade emotional. The less emotions you have, the more clear your thinking is, the better your decisions are. And So just that's a common theme with me, is to try to remove emotions, try to remove subjectivity, and keep things as objective as possible. And one thing that traders can have a tendency to do is lose sight of what do they actually have in their basket. How much risk, how much sensitivity is what's in their basket to particular movement in stocks of some kind. And how do you even quantify that? How do you measure that? And that's where delta comes in. Delta is effectively a measure of risk. And it's not just risk, but it's directional risk. And what that basically means is delta is a value. It applies to all aspects of trading vehicles. Okay, it's used in options. It makes sense in equities, bonds. Everything has a delta associated with it. And all delta really means is what is the movement in price of object A when object B moves like something moves some distance. So it is the price movement relative from one vehicle to another. And the delta can range from really big negative numbers to really big positive numbers and everywhere in between. So if you see a positive delta, what that means is whatever delta it is associated with, let's say a positive 10, if you had a 10 delta, that basically means for every $1 in whatever your delta is in reference to, your holding will move $10. In a negative delta is the exact opposite. So every time that a particular stock would move up $1, let's say, then if you had a delta of negative 10, your holdings would move down by negative $10. And so you really can do delta against anything. So inherently, the first time you look at a delta, it's going to be weighted against itself. So for one share of stock, it will always have a delta of 1. When that one share of stock goes up $1, your position goes up $1, right? Because it's weighted against itself. So if you have 100 shares, when that stock goes up $1, your portfolio goes up $100. Your delta is 100 on that particular underlying. Where it gets more interesting is when you measure the delta against something like an index. So you could have a stock like Apple and weight it against the S&P. So when the S&P goes up $1, your Apple stock might go up 30 cents or 33 cents because Apple is a component of the S&P and it will move with some delta relative to the S&P, but it won't be 1 for 1. So the closer you get to 1, when you're beta weighting against the S&P, that means the closer that moves in synchronous to the S&P. The closer you get to negative 1 means the stronger it is the exact opposite of the movement of the S&P. What that allows you to do is look at all of your positions in your portfolio normalized against a common denominator. So usually, your portfolio might have Apple, IBM, ExxonMobil, BP, something like that, all these things. And how do they move relative to each other? Well, who knows? And it makes it really hard to understand what type of risk do you have in that portfolio when you just have this kind of mixed bag, different quantities, different things like that. And the delta weighting allows you to normalize all of that. Think of going back to mathematics when you want to add different fractions up. You have to find the common denominator before you can add and subtract those fractions or the numerators from there. And that's really what delta allows you to do, is get to that common denominator. So let's move a little bit forward on this and let's start going into portfolio delta. So you can use delta, like I said, for individual stocks. There's delta meaning for options, things like that. But the scope that I want to talk about today is portfolio delta, is understanding what is that directional risk in your portfolio. And so, that method of weighting the deltas against something else like an index is called beta weighting. So you're basically beta weighting your portfolio against another underlying Typically, you'll do it against an index like the S&P, and you'll see, okay, how does this stack up in my portfolio? What that will allow you to do is understand what type of deltas are you comfortable with. If your deltas reach a certain level, sure, if the market goes in your favor, you're going to the moon and you feel great. But if your deltas are really, really high and price starts going in the other direction, your losses on that portfolio are going to be huge in that particular day. And that can make certain traders uncomfortable. That can be things that are like, that's too much price movement, too much volatility in my portfolio. And so understanding that delta can help you reduce that volatility and price movement in your portfolio and get you back to a more comfortable level for yourself. And really this all comes down into, if you know your delta, you'll know your risk. So before we get into some of the trades that I want to call out where there's different strategies in managing your deltas and things like that, let's take a real world example of a portfolio. So we're going to jump over here to Thinkorswim. Thinkorswim happens to be the platform that I use. This concept is not unique to Thinkorswim. This is a concept in the entire industry. So you should be able to do this in whatever broker you use, whatever trading tool you use. How you do it, you'll have to look it up, but it's beta weighting and then looking at your deltas. And so what we have here is a basket of stocks that I own, stocks, options, things like that. And the important thing that I have on this column here is my deltas. So that's this column right here. And when you look down here, you can see things like, here's Amazon. I have 100 shares of Amazon, and you can see that position is 100 delta. So right now, I'm not applying any beta weighting, any delta. All these deltas are relative to the holding itself. So, Carvana, I have 100 shares of that. It's 100 delta. When you get into some of these options that I hold and futures, now the delta is a little bit different because that means the futures or the options are actually a derivative. And so that says, hey, when the actual underlying is, so for example, I have some Citigroup options right here. And when Citigroup moves $1 up, my portfolio or my holding will actually move $15 up. If Citigroup goes down $1, this position will go down by $15. You can see the total delta of my portfolio. Now, this is not beta weighted, is almost 1,100. Well, that doesn't really tell me much, right? Because we're comparing apples and oranges and bananas here. So these deltas don't mean much relative to each other. They only mean something relative to the actual line it is that's of itself. So we're going to go ahead and turn on beta weighting here, and we're going to beta weight my portfolio, and we're going to look at the deltas relative to the SPY. So this is putting everything with a common denominator. So I'm going to check this box that says beta weighting. You can actually pick any ticker you want up here. I'm going to use the SPY. That's the S&P index. And now all of a sudden, look at what these deltas change to. Okay, I'm going to flip this on and off again, paying attention to those deltas. So all these things that were 100 delta, Amazon, Carvana, Plug, RBLX, all these things, when you turn on beta weighting, those deltas start getting pretty small. And that is because now everything here in this delta column is relative to movement of the S&P. So Amazon now. So what this 3122 means is if the S&P goes up by 1 point or $1, my position in Amazon, my total position in Amazon, all 100 shares will go up by $31. And if you sum all these deltas together, they're in groups here. So I'm going to turn these groups off. So now everything is in one column. And what you can see here is in my portfolio, if the S&P goes up by $1, my entire portfolio will go up by $57. If the S&P goes down $1, my entire portfolio will go down by $57.
So in this case, because you have a beta weighted delta of 57.16 there, you are essentially applying a bullish view of the market. So if you were worried about, not worried, but you were anticipating a bearish market or the S&P going down, you would want to alter your positions however necessary to, let's say, get that to minus 57.
Exactly. So if you had a bearish tilt on the market, you would want your overall portfolio to reflect that in its delta weighting. Now, one of the things that I use the delta for is if your deltas get too far in one direction or another, it can be very, very uncomfortable, because if you get this, I think the S&P moved down, let's say it moved down 0.25%. I don't actually know how much it moved down today, but 0.25%. So that's roughly 10 points. And if I had a delta of, let's say, 200 and the S&P went down 10 points, my portfolio is going to lose $2,000. And that might not be okay for me, because maybe that's too much of an uneasy feeling. Now, maybe I want to keep a bullish tilt on the market because I think the market is going up, but I know the market is going to have these swings down, and I don't want to be stressed out at night. I don't want to be uncomfortable. So I know that, if I have a delta of 200 on those swing down days, which we're going to have, I'm not going to be comfortable with my portfolio. It's going to make me feel bad. And so I would want to trim my deltas, basically bring those lower so that I reduce that directional risk, which means I reduce that massive price movement. And the way you can do that is you either get rid of positions. So if I was to sell some of my Amazon shares, for example, that delta of 30 would come down because I have less stock. So if I basically cut my Amazon position in half and I had 50 shares, so if I cut 15 off of my Amazon, that delta would become like 42. And now I've reduced that delta risk. The other way that you can pick up deltas, and I had it up there actually real briefly on this slide here, is you can have holdings that are negative delta. So they actually make products out there that are called inverse ETFs, and they are specifically designed to be a counterweight to some particular stock or a particular sector. So for example, there's a ticker out there, SF, and that is the inverse of the S&P. So when the S&P goes up $1, that ETF goes down $1. And if you have that type of thing in your portfolio, you can then reduce your deltas that way. And I have something like that. So this very first row here is a micro ES future, and I have shorted that future. So basically, I'm betting that S&P is going to go down. So every dollar that the S&P goes up, that holding goes down by $50. And that helps reduce that risk. So if I didn't have this MES future, this would be a delta of 107. So I was able to basically cut my deltas in half by adding this short MES position. So before I get in, I'll jump back to showing you a little bit about how to manage your portfolio, but you might think, okay, I kind of like the sound of this. I can reduce the risk and I reduce this volatility of movement by getting my delta as close to zero as possible. And, maybe that's a good thing. That's pretty comfortable. But wait a minute. If I actually truly have a delta of zero, when the market goes up by $1, I make no money. The market goes down by $1, I make no money. So why would you want to keep a delta of zero? That is where premium selling comes in. So coming back to that premium selling strategy that I have is I prefer to make profit on theta decay, time decay from an option basically going to zero. So that coupon decaying away. And so for me, if I can maintain a delta of zero, that's wonderful, because the market can go up, the market can go down. My portfolio is going to hold its value, but I am going to profit by the theta decay that comes off those options every single day. And so I have a screenshot here of a trade that I put on the Russell, which is the it's an index. It's a smaller cap index. It's a strangle. So a strangle is considered a delta neutral trade, where you basically put, you sell a put and you sell a call, which basically means you're playing both sides. You're burning the candle at both ends, and you're saying this stock isn't going to go too high. It's not going to go too low. It's going to stay here, right here in the middle. And if you look here in the center, there's 3 rows of prices. There's one that says 1999, one that says 1803, and 1623. So at the time this screenshot was taken, 1803 was the current price of the Russell. And that current delta was 42 cents. So pretty close to zero. And then the theta was 47, which basically means every day that goes by, that option will increase by $42. Well, I get $42 in profit from it. So if my delta is zero, I have no directional risk. Doesn't matter if we go up, doesn't matter if we go down. Price is not going to change because the price moved. The only thing that's going to change the price of the option is $42 is going to come off that option every day. And so this is why I like to hold a delta neutral, because my portfolio doesn't massively go down or massively go up every day. It just incrementally goes up in value from the theta decay. So as an example, in this yellow box here, if you have a portfolio of about $25,000, these are some of the rules that I kind of put on there. The idea is that I try to keep about 25% of my buying power free. So I basically will only trade up to 75% of that. This is to count for float of the price, buying power expansion, things like that. And like I mentioned, as soon as delta moves, your delta is no longer zero. So as soon as price goes up by $5, now boom, your delta has changed. And you can't constantly be changing your delta every microsecond or 10 seconds or minute or 10 minutes or things like that. So there has to be some threshold in which you consider to be zero, even though it's not literally zero. So for me, that is, if the portfolio size is 25,000, that is plus or minus $50. So that is a delta of plus 50 or minus 50. If I'm somewhere between there, I'm considered delta neutral. And then I don't really start to consider adjusting my deltas until I become like double that or outside of that. Really kind of just depends on market factors. But for example, in the portfolio I just showed you, I shorted the MES futures to basically bring down my deltas. Well, my deltas were approaching 100. That was a little bit too high for my particular trading style when they're beta weighted. So I said, I need to pick up some negative delta. So for me, I decided to short the MES to bring those deltas down. And then that brought the deltas down, you saw in the screenshot, to that 57. Well, yeah, that's just slightly outside of zero, but that's okay. And then I try to maintain a daily theta target of, in my portfolio, collectively, all my positions, are they decaying at about $75 a day? Which means if I hold my price steady or I hold my deltas neutral, it doesn't matter what the market does, I'm not going to be moving much in price, and I'm going to pick up $75 in theta burn. And so at that rate, that is kind of some of my trading targets when it comes to why am I trying to maintain a delta neutral position, and how does that play into the thetas? And like I mentioned, I don't want you to think that, oh my gosh, I don't really care about deltas because I'm not selling premium. I'm not trying to do this theta decay that Sprocket's doing. It applies to your portfolio in general, like I mentioned. So if I kind of come back here to that example I have, knowing where your deltas stand, or knowing if one of your positions is just crazy high delta or crazy low delta, and that makes you uncomfortable, maybe you don't not as bullish on that particular thing relative to the market or stuff like that, that's where this will gain awareness and let you look at some of that risk that is out there, so you can judge what is okay for your particular trading style or what is not okay for your particular trading style. The next thing I kind of want to just show you briefly is I'm going to come over to a live P&L chart of my portfolio. And this is another thing you can do in Thinkorswim. Like I said, this is not unique to Thinkorswim. Every broker should have something like that. But you can come into a profit and loss area, which kind of gives you your forecasts, your ups, your downs. I can actually switch this to a portfolio beta weighting here. And when I do that, it will actually go ahead and list all of my positions in conjunction with each other. Like if I scroll down here, it'll take you through all the different things that I have open. And up the top, it'll give you your collective delta, your collective theta. Now, this is going to beta weight them to whatever I have up here. So I'm going to update this to the SPY so I can beta weight my whole thing against the SPY. And what I'm going to show you here is what I just mentioned about that MES future. So what I want to show you here is one of the things that you can do with this portfolio analyzer here. So I'm going to go ahead and take off that MES short. And I want you to pay attention right here to this row in the middle of these price slices where the delta showing here is 98. So it says, hey, in your current portfolio, without this future on, this shorted future, the deltas are $98. And you can come over here, the theta here is 74. So my portfolio without that future is basically decaying at $74 a day. Now, like I mentioned, this delta is a little bit high for me. I like to keep my delta neutral. And so this is approaching that double my delta target. So if I come in here, I added that future short. And what you can see is all of a sudden I brought down my deltas. I cut them in half, but my theta didn't change because my theta is still burning away $74 a day, and the delta is holding at now 48. So right there, I've reduced my directional risk, but I have not reduced kind of my theta decay. And that's the trading style, the trading thing that I'm kind of going for. And this can be replicated no matter if you use options or otherwise. You can look at your P&L relative to whatever ticker you want to put up there, so it normalizes your whole portfolio and really lets you visualize that objective directional risk. So let's go back to that Russell trade that I was talking about. So we're going to drop this whole portfolio. We're going to go specifically into the Russell trade that I have going, which is a delta neutral trade. And I want to call something out here. So this middle price slice is currently where the Russell is trading. This is actually pretty close to delta zero, like absolute zero. So this Russell is negative 60 delta, 42 theta, dollars in theta decay. But what I want to show you is pay attention to the delta number here in the middle where it says negative 60 cents delta. And as this price moves down, look what happens to that delta. It's going to start climbing and climbing and climbing, because basically the lower and lower I get, the more positive delta I have, because the more that this directional movement of price going up is going to impact me. And so as this particular slice gets, higher to the upside, I'm going to pick up more and more negative deltas. And so what you do when this particular price slice, maybe it goes to the upside with this negative delta here. What I might do is maybe my deltas become too negative, so I need to pick up positive deltas. And so what I would do is I would take this lower put and I would pull it up on the trade closer to where this is at. And you can see right there, I pulled this up $50 on the Russell, and you can see I dropped that delta. So if price kind of pushes up here to the top side and these deltas become too negative, I can pick up positive deltas by bringing this lower put up closer to the strike. And that will allow me to cut those deltas down. And if I bring it even closer than 1750, let's say we bring it all the way up to maybe 1800, I can then bring that delta down to a -7. So here it was -15. I can cut it in half by pulling that delta all the way up.
So it sounds like these are, like, I follow all of the intentions and motivations behind it. delta neutral and whatnot, because you want to really seize and capture that theta decay. But like you said, as price moves, delta moves and whatnot. So it sounds like, correct me if I'm wrong, this isn't exactly a passive strategy. And I'm not implying a passive strategy exists per se, but it's not exactly a passive strategy, because you do need to watch your delta and adjust accordingly whenever you see it start to swing outside the realm of what you're comfortable with, right?
Yeah. I mean, that's the way to look at it. It's not, if you want to manage it, I guess I'd like to try to keep it maybe a little more focused on what you're comfortable with, right? So let's say you've got a particular portfolio and you want to go put a new trade on. One of the things you can do is say, if I put this trade on, how is this going to impact my delta for my portfolio? So maybe you don't try to readjust, because maybe your strategy isn't so much that theta decay and you're okay with a particular delta range, but you want to go make a new trade and you want to say, what is this trade? How would it hit my portfolio? Looking at your portfolio, putting that simulated trade in and seeing what it does to your delta, that will give you some feeling as to what that overall impact is on that trade. And maybe you get real aggressive. You're like, wow, this stock is going to the moon. I'm going to buy 10,000 shares of it. And you want to look at what that does to your portfolio. It might dramatically put your deltas of your portfolio like crazy in a position that you're just not comfortable with. And so I want to say this isn't so much a strategy as it is a tool for your awareness, so that you're not as surprised by what might happen in a particular market day and you get frustrated and say, oh man, the market makers are against me, they're crushing me, or something like that. It's a way to, kind of normalize and look apples to apples at things.
Okay. That makes sense, because I think I had a couple moments of looking at it through the lens of a strategy of, maintaining this delta means this direction.
Well, you're right there, and I guess I used a strategy here to give you an example, but a lot of like what we talk about, it's the mechanics of what this is, and then how you apply it to your trading strategy and your trading world. That's up to you. So I kind of go back to how you and I in the 1% trades seem to be the anti-traders of each other, right? You're buying options, I'm selling options. We both understand the mechanics of it. We both use those mechanics to different ends, right? Well, the ends are both to profit, hopefully, but we use them through a different means, let's say. And so what this is about is about showing you what is the delta measurement. How do you beta weight your portfolio? What does that mean? Now, how you use it, you could devise your own strategies. I use an example of my strategy of premium selling and how that delta weighting plays into it. But that metric could very easily play into a completely different strategy.
I see. And the beta weighting, so say beta weighting against the SPY, that taking into account, so let's just keep it super simple, of Apple beta weighted against the SPY. That calculation, is that taking into account the history of the entire history of both of those assets? Or
Yes.
okay, so it's slightly lagging indicator, but obviously still useful in the right application. So back to the point of it being a tool to help give you visibility into what's happening.
Yeah, I beta weight against the SPY because that makes sense. It's relative. The positions that I have, they have some aspect to the S&P. You can do really weird things. So let's take a look here real quick. I have beta weighted here my portfolio against wheat futures. Yeah, wheat futures. What the heck does that have to do with anything? And here you go. Here's your deltas relative to wheat futures. And for whatever reason, wheat futures seem to be completely opposite of S&P movement. So 1 point in wheat futures is a 153-point drop in the micro ES futures. This delta of 0 here on USB is a US bank, and the delta of 0 here basically means there's absolutely no correlation between wheat and that bank stock. So what you choose to beta weight against is probably helpful to whatever type of overall index or something that you have. So maybe you want to beta weight because you're very tech focused. So you want to beta weight against the QQQs. And so you can put the QQQs in, and now all of your deltas are relative to movement of the NASDAQ. And so that beta weighting goes back to, you can normalize it to anything. So try to normalize it to something that makes sense.
Gotcha.
So that brings us to the end of this week's episode. Like I said, manage your risk is really where traders shine or falter. And one of the metrics that you can use to quantify and qualify objectively the risk in your portfolio is beta weighting and looking at the deltas. How you apply it to your portfolio is 100% up to you. I gave some examples on how I use it for my portfolio, but really it is a way to objectively define how much directional risk you have in your portfolio. So if you want to, you're just super strong bullish in the market, maybe your strategy is, wow, when I think the market is going to rip, I want to jack my delta way high. And maybe you want a delta of 1,000 or something just crazy. But remember, that is a double-edged sword, because that delta represents that same price movement in the opposite direction. So if you had a delta of 1,000, yes, if you went up $1, your portfolio will go up $1,000. If you go down $1, your portfolio will go down $1,000. And so it's just a way that you can then take that and decide, what does that mean to you? How does this particular lever and valve operate for you in your trading style and your trading strategy? So go out there, look for this delta weighting, look for this beta weighting in your brokerage platform, take it in the paper trading, see what happens if you throw different stocks in there, different tickers. Just experiment with it, get to know it, get to understand it. Like we always say, go back to understanding the mechanics, go back to understanding why something does what it does. And once you understand that, then you really have the power to mold it and shape it into something that is useful to you in your particular strategy. Earnings season is well underway. Lots of things happening out there in the world of earnings. I've been actually putting on quite a few earnings trades. You can pick them up at thetagang.com/sprocket888. Hopefully you find something in this time of opportunity, because earnings season comes around 4 times a year, quarterly, and it can be a blast to play. So good luck out there. Hope you find something. And remember, think outside the block.